John, great to meet you. Thanks for doing this.
Absolutely, Mike. You too. Thank you for having me on.
What a bizarre world, huh, that we live in. I mean, you're a simple guy. You break out to do some breaking news stories that people weren't aware of, and now you're getting all this attention. Probably some good, some bad, I'm assuming. And you're getting hit up to do all kinds of shows, and it's got to be a little. It's a crazy world we're in with all this stuff.
A little bit. I mean, in all honesty, I appreciate the publicity for a couple of reasons, right? I mean, I would be lying if I said I didn't enjoy it a little bit personally, but it's also, I think, an issue that is of public interest, and I think it's something that most people had genuinely no idea about, and probably that probably explains why some of the most egregious kind of cases of abuse of the of FHA loans have resonated so well. So yeah, I'm glad the story is able to get out and be told.
Well, and so Melody, I've had on here a bunch, and Melody Wright for people that people know by now, and she was the one that first brought attention to what you were doing, and she actually even mentioned you in our last conversation that we recorded about a week ago, which I encourage everybody to listen to. And I consider Melody a friend. I met her a couple of years ago, and the information that she provides is just so valuable. And give her another plug for people that don't know. Go to her Substack and support the work that she's doing. But for people that don't know you, John, if you don't mind, just sharing some of your background, and then we'll get into what you've uncovered and why you're here.
Sure. So, yeah, my professional background, I spent close to 2 decades doing mortgage technology. So I was designing and developing the systems that are used by mortgage originators to make loans, and then for mortgage servicers to collect the payments and service those loans. And then if they go into default, handle loss mid or all the various aspects of default servicing. So um, did spent a lot of time in that industry, and over the past couple of years I started kind of dabbling in financial research, particularly around like the way that the plumbing of the US Treasury and the Federal Reserve and how all that stuff works, and started a Substack primarily to kind of go through and explain what was really going on with, say, the Fed's quantitative tightening program. And then eventually built a model that projects forward what daily Treasury spending will be each day, and what the Treasury is, the debt that they're going to need to issue in order to fund that spending. And doing this, I really enjoyed it, which then led me at a certain point last fall to be, well, let's actually see if I can go and make this be a full-time gig, right? Instead of just being it's kind of a side hobby. And around that time is when I discovered that Ginny May, who issues, and at some point in the conversation we might want to kind of double back and me give a little explanation, but Ginny May, who basically has 6.8 million of the 7.8 million FHA loans, that they issue performance data at the loan level on these loans, on these 6.8 million loans every month, and that they've done that for years, for a decade plus, in fact. And so, being familiar with technology, I started to go and download this data and want to go take a look at it, because I've been looking at this data all my life, from a mortgage technology person's perspective, working at the places that I've worked, so I'm familiar with it. But I wasn't aware that almost the full breadth of the country's mortgages, that there's performance data that's publicly available out there. So I went and I grabbed it and I started working with it, and then I started to tweet what was going on with respect to the FHA default rate, and like, or the delinquency rate within the FHA portfolio. And as I was doing that late last fall, and this was just at a very high level, how many loans in the FHA portfolio are more than a month late, how many are more than 3 months late for serious delinquency. I I was tweeting about this, and Melody, who you just mentioned, Melody started following me, and she messaged me and said, "Hey, where are you getting your data?" And then that kind of led to a an ongoing dialogue between me and Melody, and that led to a conversation a little more than a month ago where we were chatting, and I was showing her some of the data. At this point, it was the January FHA data. And as we were just chatting about that, Melody was like, I wish somebody could quantify what the redefault rates were, right? And so, what's a redefault rate? That's a mortgage that went delinquent, or and then actually went seriously delinquent, was able to be cured through some mechanism, either loss mitigation brought it current, and again, we can kind of go in to explain what those things are.
Yeah, let me cut you off here for a second because yeah, I want to, if we can, go ahead and explain that.
Okay, yeah, absolutely. All right, so you know what? Let's start lending in general, right? Lending in general, lenders, the Rockets of the world, maybe your local bank, um, they they lend the money to you, but they all have kind of one thing in common, which is that they want to then sell those loans so that they can recover the money to lend again. And that's where I mentioned Ginnie Mae. That's where Ginnie Mae comes in, because through the mortgage-backed securities of Ginnie Mae, so all these loans, they get sold, they get packaged up into these securities, and then ultimately those securities are sold to investors, right? Those investors may be banks. There's all sorts of folks who invest in mortgage-backed securities. But
401ks, John, 401ks, part of that, or
sure,
private
sure.
equity, or
Pension funds, yeah. I mean, you've got some REITs that do it, and I mean there's all sorts of entities that invest in these mortgage-backed securities, and they ultimately provide the money that then goes back to the lender, and then they use that money to lend to the next guy. The point being there that's why you have 6.8 million of the 7.8 million FHA insured loans are all in these mortgage-backed securities. And so the FHA insures each one of these, right? So if there's a loss that's incurred on the loan, so that would happen if a borrower didn't make their payments and then was ultimately forced to sell in a short sale, or was foreclosed upon. Any loss on the property, or any loss on the loan, the FHA covers. So as a result, the FHA sets the lending. They both set kind of the underwriting guidance, the lending standards for this, and then the FHA also defines what the loss mitigation standards are going to be. And what's loss mitigation? Loss mitigation is when a borrower stops paying, and the lender engages, or pardon me, the servicer engages with that borrower to try to see what can be done to bring the borrower current. Maybe the borrower is legitimately hitting a rough patch. They lost their job. There was medical expenses that came up, and they couldn't pay their mortgage for 3-4 months, but they can pay it again now. In that instance, the lender, or the servicer will work with them, to try to get a workout where they can get to where they are performing on the loan. And by performing, that means that they're paying their monthly mortgage payment and staying current. So the FHA kind of tells the servicers, these are the various options that you can offer them. And these are the rules upon which you will offer them and when you will offer them, et cetera. So from a policy perspective, the FHA the FHA specifies all of this. Uh, so bringing that back, I suppose, to the conversation with Melody, what Melody was interested in knowing was, okay, if a borrower previously got a modification, so they got brought current, or if they got brought current through some other loss mitigation tool, then what are the percentage of those loans that are going back into default? And then there was a kind of a corollary question, which was that she wished she could see like the loan level detail, the full payment history on these loans, because each of these payment histories tells a story about what's happening on the loan. And Melody gets to see that in her servicing clients. She'll see that when she does loan level reviews. Every loan level review is a story that kind of emerges from the data. But nobody was generating loan level stories at kind of a portfolio level, at a 6.8 million loans portfolio level. And all that data that I had downloaded from Ginnie Mae in the fall, that's where that came into play, because I was able to construct those loan level histories of what's going on for essentially all 6.8 million loans. And then I add to that story every month when Ginnie Mae releases the previous month's performance history. And for each loan, I can see the story, and a number of stories start to emerge out of the data that were, in some senses, surprising. And those are the stories that I tell with my FHA loans of the day. Some of the egregious ones. I mean, the reality of it is many of the stories, tell a story of a borrower who's paying their mortgage every single month, but some don't. So that's kind of Melody's role in the FHA loan of the day. It was kind of her prompting, that question from her, that led me down the path of, wow, to first go look for the stories, and then once I started seeing what some of these stories are, to start to talk about them.
So, a couple things. Wait, Jenny, forgive me for not knowing this. Jenny Mae and Fannie Mae, what's the difference? Is there
So
a difference?
they're different agencies. So Fannie Mae and Freddie Mac, they used to be private, right? They were government sponsored enterprises, but they were not effectively owned by the government. But then the U.S. government took them into conservatorship during the financial crisis, and so for all intents and purposes, they've kind of owned them for the last 15 years. They work a little bit differently in terms of the way that the mortgage-backed securities work versus Ginnie Mae, but conceptually they do the same thing, right? They bundle loans together, loans get bundled together in their securities and then sold off to investors. And they set their own lending and their own loss mitt procedures for their loans, but their loans are generally to folks with better credit, or better credit worthiness, right? Which is both usually a better credit score, higher incomes, lower debt to income ratios, and so Fannie and Freddie securitize generally the better loans, right? That are going to more likely to perform better. Whereas Ginnie Mae, they provide the mortgage-backed securities for FHA guaranteed loans and VA guaranteed loans, and then also rural housing and USDA and some much smaller guarantors within the federal government. So all the Ginnie Mae loans are explicitly kind of federally backed, and so are Fannie and Freddie these days because they're under conservatorship. But that it used to just be an implicit guarantee, which the government made good on, and the GFC and Impact honored.
The government's got their hands in everything, don't they, John?
They do have their hands in a lot, for sure.
So okay, so the modifications, you went back and looked at the ones that were modified, that were delinquent before, that were brought up current, right, through some type of modification. And correct me if I'm not summarizing this accurately. So you went back and looked at the people, the loans that went delinquent, that they modified and they were able to bring back current, and how many of those percentages fell back delinquent. Is that correct?
Yeah. Specifically, I went and broke down the portfolio by okay, well, what's the delinquency rate of loans that have a loan type of purchase versus what's the delinquency rate of loans that have a loan type of non-HAMP modification. Um,
What's non-HAMP modification?
so,
Simple terms,
HAMP,
John. Talk to me like I'm five here.
nope, you're good. You're good. I appreciate you reeling me reeling me back in. So, loan modifications and the how they work have evolved over the last 15 years. Throughout the 2010s, most of the loan modifications that were performed were kind of called HAMP, home it's making home affordable program. I forget exactly what HAMP stands for, um, but they were FHA had HAMP mods, Fannie and Freddie had HAMP mods. So from a perspective of Ginnie Mae, the HAMP mods are mods that were modifications that were originated sometime between the early 2010s and the early 2020 to 2021. And then FHA replaced their modifications during the pandemic with a different set of modifications that they called the COVID-19 recovery modifications. And those are marked as non-HAMP modifications. Although it turns out there's also some pre-HAMP modifications from like way back prior to like 2010, 2011 that are also marked as non-HAMP in the data. So as it turns out, you have to slice and dice the data carefully to really see for the population of modifications which ones are performing terrible versus which ones that are performing just not great. But both sets of modifications in general perform worse than loans that were made for someone to purchase a home, or loans that were made to do a rates refinance during the pandemic, or even a cash out refinance, right? But each of these subsets tells a little bit of a different story. But the story on the modifications was a little bit striking, and that's when I dug in and ultimately said, okay, well, how are the modifications that have been performed over the last, say, 2.5 years performing? And those are the ones that are shockingly bad. Those are the ones that touch on 70% delinquent, 55% serious delinquent when you look at those modifications, and that's where the real problem within the FHA portfolio is, and that's when the loss mitigation procedures for FHA tighten up again, which they will in February 2026. That's what's going to be a challenge.
This episode is brought to you by McIlvaney Financial Group. Their advisors bring a depth of knowledge and experience that allow them to serve their clientele with care, ensuring their financial needs are met now and in the future. Personally, I'm not saying cash is worthless, but you can see what's happening. It's worth less every year. Gold is the opposite. Click on the promo link in the show notes or go to www.mcilvaney.com/coffeeandamike. It reminds me, I worked at MBNA America a long time ago, and I was doing credit card delinquency at that time. And it was, I don't remember the percentages or anything, but it was like our job was to get these accounts current. So we would set up a monthly residual. We called it, was it term? Re-aging, I think it was called. And you had multiple payments. It was called MAPS. And you do 3 months in a row, and it would automatically bring them current, no matter what the balance was. 3 minimum payments. And then in the fourth month, they'd be brought back up to current. And I want to say it was like 90% of those people just felt delinquent again.
Yep. Yeah, that's kind of the same. That's kind of the same idea with looking at re-delinquency rates for loans that had previously been previously been so delinquent that they had to receive a loss mitigation workout to bring them back to current.
And then they fall behind again, right? I mean, ultimately they just keep falling behind, and they never get caught back up.
Yes, and historically, I mean, this has always been present in mortgage portfolios. This is nothing new, and it's no surprise that a borrower who has had to receive loss mitigation in the past is likely in the aggregate to perform worse than a borrower who's never had to receive loss mitigation. So that's not what really is a surprise. The surprise was the disparity between the rates. I mean, 70% delinquent is just, like, it truly is shockingly bad. I mean, I know many folks within the mortgage industry. Some are very, very grizzled veterans in the mortgage industry who were sort of taken aback by what those numbers represented. And that, like, when you see numbers like that, then that leads to well, how the heck did it get this way, right? I mean, is it telling a story of extraordinary borrower distress? Partially, it's telling a story of that, but it also leads to the FHA's loss mitigation policies and how they changed during COVID and how they still are, that tell in my opinion, actually the larger part of the story with respect to those super troubled modifications that are going to be a big problem in February 2026.
So the larger part of the story then is, because hearing this, I think to myself, all right, there's people that should have never bought a home, right? So did they loosen the parameters so much to where they needed to, get these underwritten and get them, get these mortgages out, these securities, mortgage-backed securities, that they lowered the standards?
So so definitely, if you look at the FHA portfolio by creditworthiness standards, right? Credit scores, and in particular debt to income ratio. Um, it like Debt to income ratios today are in the aggregate, considerably higher than they were even going back to the global financial crisis. I mean, there definitely is some truth to the FHA has kind of taken over the role of the new subprime, um, and that definitely probably does bear a little bit, but but if you look at the portfolio that's been originated for the FHA over the last year, and by the last year I really mean 3 months to 15 months back, so that you can get kind of an apples to apples comparison on serious delinquency. When you look at it, I mean, it's not great, but it's just really not all that bad. So the Wall Street Journal article, for example, that came out that on this topic, they sort of implied that it is these borrowers with these super high DTIs that are the problem. And at least when you judge it over the 3 to 15 months and the delinquency rates there, it's that doesn't jump off the page. It doesn't jump off the page in the way that the delinquency rates for the modifications do, which again then leads back to, well, why? What caused that? What confluence of events caused that, and is continuing to cause that?
So what was the conclusions? What conclusions did you come up with then?
So the problem that the FHA had with its loss mitt procedures with respect to these modifications is, like, what happened starting in 2022. In the middle of 2022, interest rates for mortgage started spiking tremendously. Like, we went from interest rates in the threes at the beginning of 2022, or close there too, to by the time you got to middle of 2023, we're in the sevens, and we've gotten in the mid sevens at various points in time. Um, the problem that presents is, once a borrower gets in trouble, if they're going to get a uh, loan modifications for FHA, they set the interest rate for the modification to the market interest rate. So if you previously had a 3% loan with a 3% FHA loan that maybe you originated in 2021, and then you became seriously delinquent and you made the unfortunate mistake of answering honestly to your servicer that you couldn't afford to resume making your monthly payment, that pushes you per FHA's loss mitigation procedures to a modification. And what the FHA does in that modification is first they say, okay, well, let's set the interest rate to market and let's redefine the term of the loan. Let's push it out to 30 years. And let's see if that gives us a 25% payment reduction. There's 0% chance of that happening when you're increasing the rate by 2-3 points. In fact, you're much more likely to get a 30% payment increase. That's not going to help a struggling borrower. So the next thing that the FHA does is they say, okay, well, what if we do a partial claim with this? So what's a partial claim? A partial claim, when FHA does this with a modification, is the FHA will effectively advance up to 30% of the loan balance to pay down the principal of the loan. And so if you have a $400,000 loan at 3%, maybe a $300,000 loan at 6.5%, if 6.5 is market, maybe that can get some payment reduction. And sometimes it can. I mean, they kind of fight against each other, but you reduce the principal enough and you can get a payment reduction. The problem was these mods would, for the most part, I mean, they weren't able to get a big payment reduction. They might get a small payment reduction. The servicer would offer it, and the borrower at that point faces the choice of, you accept this modification, or you're going to be losing your home through either forced sale or foreclosure. So borrowers in that position, many of them took the mod. And that mod then basically eliminated any maneuvering that they might have in future loss mitigation with the FHA, outside of praying that rates collapse in order to reduce their payment in the future. And if they can't make that new modified payment, then, and it's a good question, what's next? And right now, the FHA will just modify it again. They'll modify it again. That will raise the rate, right? Assuming market rates haven't dropped, because for all the missed payments that the borrower makes after the first modification, those get added to the balance of the loan. There is no more partial claim money from the FHA. So now the borrower is left with a payment that is larger for a mod, and that's not going to help. But go another 4 or 5, 6 months, and the FHA, well, the servicer, but acting on the kind of instructions, the guidelines of the FHA, they'll modify it again. And there's examples in the data of loans getting 3, 4 mods that are increasing the payment. I mean, these loans are not viable. These are part of those problematic loans that when real loss mitigation requires the borrower to actually make a payment again, which will happen for the FHA in Feb 2020 in 2026. Once that starts, these loans basically have no chance. And it was a dynamic that the FHA now has a loss mitigation product. They call it the payment supplement, that instead of jacking up a rate from 3% to 6.5% and killing the loan, instead, they use that 30% partial claim funds to essentially supplement the payment for a couple of years, reduce it by 25%, give the borrower a legit shot, right, to get back on their feet and to get paying on their mortgage so that they can stay in the home. But it took them 1.5 years to roll the whole thing out from kind of conception to full implementation by the servicer community. And by that time, so many of these mods that just, ultimately kind of doomed the borrower were made. And that's kind of the sad story that I mostly don't highlight during my FHA loans of the day. I mean, I've been mostly highlighting more along the lines of the uh, abuse of standalone partial claims, which is a kind of separate loss emit procedure that we should cover at least briefly in a minute.
Oh,
But uh,
I was to say, go ahead now if you like.
Okay, so the standalone partial claims, and these are actually usually administered before modifications. And so the way you get a standalone partial claim for FHA is okay. You don't pay your mortgage, you miss 4 or 5 mortgage payments. Your servicer will call. They'll say, "Hey, Mike, can you cover? Can you pay to bring your mortgage current?" And if you say no, I don't have the funds to, say you got a $2,000 mortgage payment and you're 5 months behind. I don't have 10 grand that I can pay you to bring my loan current, uh, but I can make the $2,000 payment now. And that for honest hardships, temporary hardships that come up, it's a really really helpful product. Uh, and it's the right solution for a number of folks who hit a rough patch but stabilize it, but just can't really bring themselves back. Even if you were to split up that 10 grand over 12 or 24 months, they can afford the mortgage payment, but they can't afford to pay the arrears. In that situation, the FHA will they'll cover the missed mortgage payments. So they'll pay the servicer the $10,000 in 5 missed payments that the borrower didn't make. Um, and the servicer will bring the borrower current. And if the borrower then starts making their mortgage payments, then that's a loss net success story, and those are great. The problem is, the problem is, it used to be that there was a limitation on the frequency with which you could get partial claims. But in 2021, the FHA stripped that out. So now you can get effectively limitless partial claims, standalone partial claims, until you hit that 30% of unpaid principal balance. And that creates an incentive for borrowers to not pay, because so long as they're willing to go through the kabuki theater with their servicer every 4, 5, 6 months, say, no, I can't bring my loan current. Yes, I can resume my mortgage payment, none of which needs to be documented in writing, because of the laxness of the loss mitigation procedures as they were loosened up during the COVID era. This presents, I mean, you can basically go potentially years, potentially 3 to 4 years. And some of the more egregious examples that I found are borrowers who were stringing together getting partial claims, every maybe 4 to maybe as many as 10, 12 months, depending on how fast they're working with their servicer to get the next partial claim. And they're basically living in the property, and the FHA is de facto paying the mortgage for that borrower in 6 or 10 month chunks every 6 or 10 months. And how that benefits the borrower, because this isn't just cash that the FHA is effectively handing the borrower. This doesn't. The FHA adds what they've provided in these mortgage payments. They get what's known as a junior lien. So that's like a second mortgage that is repaid to the FHA when the mortgage matures, or if the borrower sells their house or they refinance their house. But if they let the loan go the distance and that go 30 years, then effectively the borrower gets a 30-year interest-free loan, up to 30% of the loan balance. And that's from a financial perspective. I mean, you wreck your credit while you're doing it because of the delinquencies, assuming that those are being reported, which they should be, but I've heard some rumblings that maybe they're not. So you risk your credit, but you in return are getting a 30-year interest-free loan, which is a pretty valuable thing. I think most folks would take a 30-year interest-free loan.
Okay, so let's back up a second because I'm missing something here. How are these people able to get it to where they have a 30-year interest only, or excuse me, 30-year no interest, interest only,
Yeah.
no
No,
interest.
no interest.
So okay, so give me an example. Let's say John Smith, how this occurs.
Yeah, sure. So John Smith, let's say his mortgage
I hope John doesn't hear this, by the way.
um, John Smith, let's say his mortgage payment is $4,000 a month, right? And he doesn't make it for 5 months. Maybe he can make it, maybe he can't.
But on paper,
But
he can't make it for whatever reason. He can't make the payment.
yeah, so in effect, I mean, I guess regardless of whether or not he can or he can't make it, that's well, I mean, it's like 5,000 or 4,000 extra dollars in his pocket every month, right? Because he's not paying that to the mortgage servicer for his mortgage payment. So, while the FHA pays the servicer in lump sum to bring the loan current, it's functionally not that different from handing the borrower $4,000 each month so that the borrower can hand it over to the servicer to make their mortgage payments. In return for a 30-year interest-free loan each month of that $4,000, and then those $4,000 loans add up over time. So that's where the value is being delivered, I guess.
Okay, so how does he qualify for that? So okay, let's back up again. He
Yeah.
recognizes that he can't, for whatever reason, he can't make the payments. Not making it, whether voluntarily or can't do it. So then he goes to the FHA and says applies for a hardship.
No, what the borrower does, the playbook for the borrower is first, they just stop paying. If you stop paying on your mortgage servicer is going to be calling you relatively soon thereafter, right? It's no different, I suppose, from when you were working.
30 day, there's 5 day,
Yeah,
30 day,
exactly,
60,
right.
90.
You're reaching out to them, trying to make contact with them and figure out how to get them current, how to get them paying again. And so they'll reach out to you, and that's where the script comes into play. Mike or John, can you bring this loan current? You're 3 months behind. Can you pay us 12,000 to bring the loan current? No, I can't. Can you resume making the $4,000 a month payments if the FHA brings you current? Yes, I can. Rinse, repeat.
Oh my God, there's so many people that took advantage of this. Then I wouldn't even need to do a deep dive, right? I mean, that's just, I'm not justifying it, but just I don't have a lot of faith in people. So the fact that once this got out, that you could get away with it, I mean, it's like blood in the water, right? I mean,
It's nuts. Completely nuts, right? Like, maybe I half get it in 2021, when we're still maybe, but you got to end that 6 months, a year after. Like, you can't let that go on. And so in February, there were roughly 32 or 31,000, at least over the 6.8 million loans that I can see. There were 31,000 partial claims that were provided in the month of February. About 8,000 of those 31,000 were repeat partial claims within the past year. Like 14,000 of them went to people who had already gotten at least one, but 8,000 of them went to people who had gotten a partial claim within the past year. And when you figure that these partial claims cover, sometimes it's as few as 4 months. Often, other times it's as many, it's considerably larger than that. It's probably on average about 6 months, 6.5 months per. I mean, maybe that isn't somebody who's gaming the system and is genuinely struggling. I don't know.
yeah, I mean, I- so many thoughts in my head right now about this. So how long does till the FHA cuts it off and say enough's enough? Like,
Well, they'll cut off the standalone partial claims right now. if you hit that 30% UPB or principal balance, which is really the loan amount, right? To try to use terms that are not as, I mean, it's not technically the loan amount, but it's pretty close. In effect, it ends up being very close because most partial claims happen relatively early on in a loan's amortization. So roughly 30% of the loan amount. The FHA will stop the standalone partial claims then. But as we discussed earlier with the modifications, they'll still give you a modification. That'll raise your loan balance, right? Probably raise your payment, may reset your rate, may set your rate higher, but you'll keep getting those. There's really nothing like you kind of can't get foreclosed on right now on an FHA property or an FHA loan unless you've abandoned the property or you completely ghost your servicer. But if you but if you play along and ultimately accept a mod, even if it's going to raise your payment, then that will keep happening. You will keep getting one. And that's a function of these incredibly ridiculously lax FHA loss mitigation procedures that have been this way since we'll say 2021. I mean, a little bit 2020, they've evolved some over time, but the real laxness hit in the summer of 2021. And they're going to be this way until February 2026, notwithstanding that they could take actions to stop, some of the ridiculousness right now. They haven't. In fact, they got extended to February 2026 in the middle of January. They were originally supposed to expire in April, so we're going to get another 11 months of this.
Yeah, it's one of those things where you might not want to necessarily get political, but how can you not, right? Like, who put this in play in 21, and for what? What was it? What was the agenda behind it? In your guess, what do you think?
So here's what I would say about 2021. I'll give a little bit of a pass because we were still kind of as a nation in I don't know, COVID hysteria, I guess. Like it was passing, but there was still a little bit. But the policy response and whatnot. I'm less cynical about that than I am about the continuing
Better
decision
than I am, John. I'm cynical on everything these days.
in the
I
years
don't trust
since
any. Go ahead. Sorry.
to not end it. But what I'm definitely cynical about, Mike, is the fact that when I said mid-January, specifically January 16th was when the FHA extended these procedures. And when I think about this, my mind kind of immediately races to, okay, well, what's the political game in that? Like regardless of what tribe or side one person may favor. It's for me, it's always I wonder what the game afoot is here. And when I think about that, I think, oh, okay, you push out this starting to explode because the modifications of doom, right? These 150,000 or so mods that are likely not viable loans. You probably, if you're the Biden administration or the Biden FHA, you probably don't want that happening early in the next administration. Much better for that to start happening early on in the beginning of the midterm year. So I'm a little cynical about that. I don't know that that's the case. Maybe this was all on the up and up, and the servicer community was complaining to the FHA that the new permanent waterfall, which ends this nonsense, is going to take them a year to implement. But I mean, honestly, the new waterfall is not that different than the waterfall that preceded COVID. So that shouldn't really be the case. But yeah, I may be a little bit cynical about that.
Well, would you have any idea the dollar amount that will potentially charge off next year when this program is supposed to go away?
Uh no. It's an interesting question, right? I mean, I can quantify the number of loans. I can quantify the amount of partial claims that we're giving stand or that are being handed out every month standalone. But in terms of trying to project, because what's important to note for the FHA, in terms of like a charge off, which I'm assuming you mean is, hey, what's the insurance fund going to have to pay out for loans that go to forced sale or foreclosure and incur a loss? Is that what you mean by that?
Yes. Yes.
Yeah.
Sorry, I'm thinking credit
Um,
card terms, charge off.
oh no, for sure. I think it's actually useful. It's useful because I think that the other folks probably that resonates with them as an analogy. But um, there's a number of factors that go into it, right? Like part of it is what just how much is FHA on the hook for, right? So they're on the hook for the full value remaining balance of the first mortgage, right? And then they're also on the hook for any partial claims that have been doled out, which have an effect of potentially putting the borrower underwater. But that relates to the home price and what the home value is, and that's what's difficult for me to project, right? Um, the If home prices, let's say that they continue to remain where they are, then there'd be some losses to the FHA on some of these loans, but probably wouldn't be all that much. If home prices start to see a significant decline, then all of a sudden the amount that you're going to recover from a short sale or the amount you're going to recover from a foreclosure for the FHA to make that becomes much less, and that would then spur a much bigger payoff on the loans. And to be honest, I don't have a great handle. I mean, I know that 150,000 loans that all start to going to for sale slash foreclosure in a fairly compressed time period in 2026, and maybe more of that just depends on the people who are in the partial claim game, how many of them are legit hardship versus just playing the game to get the interest-free loans. Uh, but like that's not going to help home prices. Like anytime you get forced sales or you get foreclosures, that's not good for home prices. I don't know whether or not it's the catalyst or part of a catalyst, because there's lots of other factors that influence. And I mean, I'm mindful that 150,000 FHA loans in the universe of 50 to 60 million total loans out there it's exactly what it is, 150,000 FHA loans. And that goes towards like what's the loss going to be to the insurance fund, and also to be sure the insurance fund has a lot of money in it right now, in large part because they haven't paid out any real claims. I mean, they've done a bunch of partials over the last 3-4 years, but there's not really been FHA foreclosures for the last 3-4 years. So it's a tough question to answer. But I'll try to come up with some sort of a model for it.
Why do you think this story has gotten so much attention?
To be honest, I think it comes down to, with respect to the story itself, I think people are kind of fundamentally offended by the idea that people are gaming a system that should be fair, right? And the folks who are receiving repeated partial claims, particularly the ones that look like they don't have a genuine hardship and they're just choosing not to pay. I think that strikes a nerve. That strikes a nerve with many people, and it is kind of legitimately unfair. And I think seeing that in the aggregate is one thing, uh, but I think seeing that at a loan level just tells the story in a way that resonates, much more with much more intensity, right? And I think that's why Melody asked the question, right? And then of it, that it stories that come out. I think people can relate to each of those loans and think, well, wait a minute, I should have done that. And that happens, much more directly with an individual loan story than it does by saying that 30,000 partial claims were completed last month. The FHA paid $250 million or so out, covering the mortgage payments of X. That resonates, just not in the same way as seeing somebody individually take advantage of it.
When I hear this, I think to myself, there was a time, I'll be 47, and like my grandparents, that generation, yeah, you'd have people that still would do it, but for the most part, they wouldn't have done that, right? Because they were based on principle, character, accountability, integrity,
Yeah.
and I just think, man, we are in a society that is literally collapsing because people will justify. I guarantee you, if we had one of these people on here right now, they would justify why they did what they did and make the argument for it. And I mean, I was not surprised by it, but it's just another reminder of like where we're at. I mean, when I had Melody on, she was talking about her trip in California and just all the homeless that she saw. And you're just like, man, our society it's just collapsing. Everything is a grift. Everything is I'm entitled. Everything it's me, 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 me. Yes, I know there's some exceptions. There always are exceptions. It's not black and white, but the overview of it is like, all right, how can I take advantage of the system? And then you don't even get penalized for it. The people that are actually doing the right thing, they get no rewards.
Yeah, I know. I, in answering that question, what I try to do is I try to empathize with the person who would come on and justify doing it. Try putting myself in their shoes and think about
You're a hell of a
what
guy,
would
John.
my,
You're my interrupter. You're a hell of a guy.
well, I mean, I think, most of the people who get FHA loans, they are weaker borrowers. I mean, as I've highlighted, that's not always the case, right? There are $1 million FHA loans out there going to people making 300 grand plus a year, but for the most part, that's not the case. And if I were to put myself in their shoes, take a look at the COVID response, take a look at all the PPP loans that went out and, basically provided the funds for the professional class to go purchase, another beach condo. Um,
That's a whole nother. Sorry, that's a whole nother story. I mean, I knew people that had nice houses
mhm.
and they got PPP money. I don't know how much they got, but there was so much fraud. I'm assuming that went on for all that. But again, it's another example of how I'm entitled and how how can I grift? How can I, take
Yeah,
advantage of the
100%.
system?
And the worst part is, right, because while there was plenty of PPP fraud out there, just like like I'm sure there probably is an element of fraud that's taking place in the partial claim abuse. But the worst part of both programs is the policy, like the policy supported it, it allowed it. Um, the PPP money didn't have to be forgiven. Like that was a choice that our policymakers made. In the same way that our FHA policymakers have made the choice to allow this exploitation to continue. And it's a choice that to this day they continue to make. They could stop that. I mean, they may or may not, like they could stop that tomorrow by telling servicers, you have to have a minimum of three made payments before you can do another partial claim, or limit them to one every 18 months, which is what they're going to do in February of 2026. But it's a choice that they are not making right now. They've got a lot to do. They've got a lot on their plate, a new administration. But part of my goal with the FHA loan of the day, to the extent I can get it to resonate, is to hopefully reach those ears and encourage an earlier end to this, so that the FHA borrowers who are doing their best to make their mortgage payments, which the vast majority of them aren't getting penalized, because ultimately they pay for it first. They pay for it through increased mortgage premiums, mortgage insurance premiums on the loans. So really, the taxpayers are ultimately on the hook. We're kind of like a reinsurer for FHA, But the people who really bear this are the FHA borrowers who are making their payments.
Well, it's always the taxpayer that ends up picking up the check for all this, right? Isn't that usually how it works?
At the end of the day, yeah. And if the insurance fund needed bailing out, I'm sure Congress would step in and appropriate.
Well, and it takes me back to 2008 as well, because you had people that were able to just walk away from their homes. Yeah, their credit got hurt for a few years, but people that had equity lines, if there was any remaining cash left, they withdrew the money,
Yeah.
and yeah, they got a ding on their credit, or they couldn't buy for a few years. But so what? And I'm not justifying that, but this is the element of what you're dealing with in this country today.
Yeah.
So yeah, I don't, I wish I had more empathy for people. I just don't anymore, because, yeah, we all make mistakes. Sometimes you get in over your head, but the fact that we've just given out so many loans to people that probably shouldn't have owned a home, part of the reason why we're in this mess.
Yeah. It's true.
But it's like, okay, so how do we fix this going forward? Like, what is, what would you be your suggested solution so that this doesn't happen again? Because I have to imagine whatever this bomb is going to go off next year. It's got to be pretty substantial, I would think.
I mean, 150 to 200,000 loans that I see no real chance of being viable aside from mortgage rates collapsing between now and then, which I mean, it could happen. I don't think it will happen. Um, and even then, that won't save. That wouldn't. There'd still be a big chunk of those that wouldn't save. And it may be more of that. Exactly how much of an impact that will have, I don't know. There's varying opinions on that, but it's not going to be helpful. I mean,
I mean,
it's going to be a mess.
I just did the math. 200,000 times, let's say the average cost of the house is 150,000, and I got 3 to the 10th, 10 zeros. So what is that? 30 billion?
Something like that. I mean,
Isn't that bad? I don't even know. I can't even do the old math on that. It's make fun of me. It's 9 zeros, right? Yeah. So that's 300 billion.
Yeah, 300 billion. There we go.
And I'm sure the average home price. I just threw out a number, but I think 150,000 is probably low.
Yeah, it is. And actually, I think it is 30 billion doing the
Did you say 30 or 300?
30, 30. But 150 is probably low. So I mean, it's probably, I don't know, probably 250, maybe 230 would be my guess for the FHA portfolio.
So that's 50 billion if you do 250.
Yeah. So to put it in perspective for the insurance fund, right? The insurance fund has like 140 billion in treasuries right now. Um, so 150 billion isn't going to break the insurance fund by any, or 150, pardon me, 150,000 loans isn't going to break the insurance fund by any stretch. Um, the but you know what does that what does that do to the broader home market? It's what I can say confidently is that over the last 4-ish years, there have been effectively no FHA foreclosures, right? I mean, there have been a few, but there really haven't been any over the last 4, maybe 5 years. And that has an effect. That has an effect on home prices. That has an effect on affordability of homes. And how much, we'll find out next year.
So you're going to see a flooding of these homes that'll probably hit the market again.
Yeah, I mean that's what will happen. I mean, will they all be foreclosures now? Probably most of them won't. Probably most of them will be for sales, but some of them will doubtlessly go to foreclosure. For the borrowers that have no that are underwater, who have been taking mods that raise their payment. I mean, their incentive is to fight to the bitter end.
What do you expect the residential real estate market to look like around that same time next year?
Uh, I mean, not a forecaster with respect to housing
But
prices, right?
just guessing where you think it's going to be at, percentage wise, a better, worse,
Oh, I think
fall
it'll
off
be
a cliff.
worse. No, I think it'll be worse. I think with the FHA impulse, the forced selling slash foreclosure impulse that'll hit next year will make it. Obviously that's going to impact it to a degree that's playing out now in the VA portfolio. So it'll be interesting to see and there's fewer numbers of seriously delinquent loans in the VA portfolio, um, but there hasn't been much, if any, foreclosure activity in the VA portfolio either um, for the last since COVID really, uh, and that there was a moratorium on foreclosure that ended in December, and now the VA is kind of reaching its reckoning, except that the VA has a program, a special modification program that will modify loans as a last resort to keep veterans in their homes to a 2.5% rate, potentially 40-year term, and see if that gets them to a payment that the veteran can afford. And that'll solve a number of their loans, but it won't solve all of them. And it'll be interesting to see how many it doesn't, because that's going to be increased forced selling or foreclosures coming on. And then there's a question of how much of this is in the GSE portfolios. I don't have as good a visibility into the GSE portfolios yet, because while I have some, I don't have the extensive payment histories on these loans like I do for the FHAs and VAs, because the Fannie and Freddie portfolios are enormous, and I haven't had time to load and crunch the data yet. But the headline delinquency rates for those portfolios is much lower, like an order of magnitude lower than FHA. But their portfolio sizes are larger, and their average loan sizes are going to be larger. Um, I I'm I think probably there's not this huge pocket of distress in Fannie and Freddie, but I don't know that, and I'm very cautioned, when folks like Melody, I don't want to put words in Melody's mouth, but I think, there are folks who think that there's a bigger pocket of distress there than you see from looking at the mortgage-backed securities data, because of effectively Fannie and Freddie buying them when they go seriously delinquent, buying a number of them out of the MBS pools, and then pushing them to kind of other places where they're not so easily found, so to speak. And she may be right, so I don't know. So I think in the aggregate, and when you take what's likely to happen, I think with tariffs, and if Doge restricts the federal spending impulse that's been kind of powering a lot of growth, I think, over the last 3 or 4 years with the deficit spend that we've been engaged in. If that's curtailed, then you've got a lot of factors that are pushing against housing, in that scenario. So I mean, I say in the whole, I think it's lower, but again, I'm not really in the forecasting business. I just kind of forecast the impulses that I can see, and then try to come up with a swirl answer for them.
John, let me correct you. Melody's always right. Okay, she's never wrong. So anything, she's the boss. She's the queen. So what is your primary focus now as we move into 25 and leading into this potential real estate bomb next year?
So my primary focus in the short term is to quantify as much of the rest of the portfolios, as I can, right? Like I've sliced and diced the FHA portfolio in such a way that, that I feel pretty comfortable that I understand what's going on in each of the cohorts. And that's one of the things that I provide, well, what will be ongoing monthly reports for. I mean, I was previously providing monthly reports of the headline delinquency rate quicker. You know, we were talking about time advantage or temporal advantage off the air. Like the FHA will tell you what their full portfolio delinquency rate and serious delinquency rates are, but they do it 3 months back. Whereas you know, I can crunch the MBS data and provide it on like the ninth day of the month, past the month that it's as of date for, right? So that's what I was doing, and now I've expanded that to, okay, here's all the slicing and dicing of the portfolio. Here's what, you know, those modifications look like. Here's what recent originations and their performance is looking like. Here's what I've dubbed the pristine FHAs, the ones that have never had a partial claim before, or a modification. How are those performing, and what's the trend in their delinquency? So my immediate focus is to extend that to the VA portfolio and then over to Fannie and Freddie's portfolios, in order to try to get a real sense of what's happening under the hood. Because these delinquency rates are, as you know, the headline delinquency rates, they only tell so much data. So that's what I'm immediately focused on, and that'll give me a pulse as to what's evolving. Because you know, loans go delinquent, and you know, most of the loans are in these MBS portfolios, and when they go delinquent, you know, that's when they might get removed out. But I'll be able to see that delinquency impulse better, and quicker, and that's what I'm focused on, with the ultimate end goal of my thesis is you can't understand what's going to happen with respect to delinquencies without kind of a rich understanding of the loss mitigation procedures that are available to each loan and what's likely to happen to each loan, in loss mitigation, right? Because if there's going to be a loss mitigation workout, then yeah, the loan goes delinquent, may go seriously delinquent, but then it's going to cure with some sort of loss mit workout. And anybody who's looking for the impact that that's going to have on future housing is, I mean, it's going to have no impact, right? Because they reached a resolution, and that loan's going to continue on. And particularly like with FHA right now, that bears out. I mean, yeah, headline, we've got 10% delinquency rates, and none of it matters because nobody can get foreclosed on right now under the procedures. So the delinquency rate could be 100%, and it wouldn't matter because everybody would then just get one of these partial claims or a loan modification. But that will end. And ultimately, what I'm focused on and what I'm trying to get built is to have, for all the 40 million mortgages that are in these MBS pools, to be able to kind of forward project loss mitigation on everyone that starts going delinquent, to be able to get a real granular and realistic projection of, you know, what's likely to happen. Is this loan likely to have a loss mit cure, or is this loan likely to not? Like, if I were to project it on these mods of doom that have already exhausted their partial claims, yeah, those are going to project to go to for sale or foreclosure. If I'm projecting loss mit on a loan, a purchase loan that has a 3% rate that's never been delinquent before, well, I mean, I'm going to project that that's going to cure, and that you know, that's going to have no impact. So that's what I'm attempting. That's what I'm attempting to build. It's a little ambitious, and it'll take me a little time, but I think I can get there.
Where can people find you, John?
On X, they can find me at John Comiskey 77, which I think is actually they've been staring at all conversation. And then my Substack, Reverse Engineering Finance, can be found at John Comiskey, all one word, .substack.com.
And for people that you have a paywall for Substack?
So I do post some free posts, some completely free posts. I post some that are mostly free, right, where the paywall is set very far down. And then There are some posts that I set the paywall fairly high up, right? But I want the free subscribers to get a sense of, hey, this is something, this is information you could have if you're willing to support me to try to make a living. And then some are entirely subscriber or paid subscriber only, because I also do projections of the treasury and what the treasury is going to spend and that sort of thing. And when I do those data releases, the data releases or the data that I provide via the Substack is reserved for paid subscribers.
So people listening, join John's Substack, become a paid subscriber, contribute to the work that he's doing. And, it's very, very important in this time that we, support the people that are putting in the work to get accurate information out to all of us. So I encourage people to do that.
Thank you.
John, thanks for doing this. I look forward to continue to following your work more and, more conversations ahead.
Absolutely, Mike. This was an awesome conversation. Super appreciate you having me on.
Mic drop.